We are living in some interesting times, and whenever things happen, like this pandemic or any other traumatic event, whether it's war or something like that, a lot of people are really concerned about the transfer of wealth that's going to occur because of this incident. So, we want to share today how you can prevent the transfer of wealth from you to others. So, what is the transfer of wealth? Well, we could be talking about the $68 trillion that's due to change hands over the next 25 years from one generation to another. Or we could talk about the $700 billion in the 2008 TARP incident that has turned into $14.4 trillion for American taxpayers. Or it could be talking about the Secure Act that became law last year, which does away with the stretch IRA and limits how you can pass on what you've saved to the next generation. But the most important thing, I think, is to understand the massive amounts of wealth that you transfer on a daily basis simply because you don't appreciate the time value of money. For example, how about the $122 billion of credit card debt interest that is paid annually in this year? That's 50% more than just 5 years ago. Or what about the $5.7 billion that American taxpayers pay willingly by withdrawing funds from their 401k or IRA early? The cost of your home mortgage interest over your lifetime, or the cost of paying cash for major purchases, or the cost of purchasing term insurance over your lifetime instead of getting whole life insurance for your whole life. According to the NerdWallet, there is currently $466.2 billion of credit card debt in the United States. That averages about $7,100 per household. As of February 2020, the average interest on credit cards was 21.21%, which was down from 21.4% just from September of last year. But taking that, let's use a 9.71% credit card on a $5,000 purchase that you pay at $150 a month until it's paid off. That means you'll end up paying $5,850 for that purchase, which is 17% more than what the purchase price actually was. It looks like this. Repeat that a few times in your life, and you've lost or transferred wealth to other people, in this case, the credit card companies. Now, according to statistics, from December of 1999 till January of this year, 2020, the S&P 500 return with dividends reinvested was only producing about 9%, 3.9 to be exactly. So we're going to use that 4% average here in seeing what that extra $850 really cost you over your lifetime. You see, $850 earning 4% over the next 25 years makes your true cost of that $5,000 purchase $7,266 because you lost $2,266 of what you could have earned on that $850. That's 45% more than what the original price was. That's a huge transfer of wealth from you to somebody else. This is what that looks like. So let's talk about your IRA or your qualified plan benefits and the penalties that are associated with that when you need to take a withdrawal from those funds before you're 59 and a half. According to the Investment Company Institute, there are 555,000 401ks that are currently active and 46.4 million IRAs. Together, that's about 46.955 million of such retirement plans. And yet today Americans are spending $5.7 billion a year on penalties when they take money from these plans before they're 59 and a half. On average, then, an American with an IRA or a 401k is going to lose about $121.55 every year due to these penalties for early access of their money. Now, what if that $121 could earn 4% annually over the next 25 years? Well, if it did, then by having to pay that penalty of $121, you just lost 166% of what you could have earned. That's huge. That's a huge transfer of wealth. That's something you can control. It doesn't have to have anything to do with disasters or pandemics or war or anything like that. These are things that you personally can control in your life. Let's look at one that might be a little bit more controversial, and that's the cost of your home mortgage interest. According to Zillow, the median price of a home mortgage in 2020 is $247,000. Now, median meaning that there's 50% of the homes that are above that value and 50% of them are below that value. But that's the median mortgage price in 2020. Recently online, a mortgage interest rate was published listing 3.86% on an approved credit for a 30-year mortgage and 3.25% for a 15-year mortgage on someone that had approved credit. Let's look at some math here. The typical financial advice you would receive would encourage you to take the lower rate with the shorter time period so that you could pay off your mortgage early and save all that interest. And at first glance, it looks like you could save a lot of money. But what if there was a better way? Consider the time value of your money and the opportunity costs of not being able to use that extra $583.21 that it's going to take you every month to contribute to your mortgage bank to get rid of that 30-year mortgage in 15 years instead of 30. By paying extra on your mortgage, you will save about $104,000, almost $105,000, but it will cost you $142,520 to do so if you could have earned that 4% average that the S&P 500 has performed over the last 4 years. So is it worth it to you to spend 104 to lose 142? It's a good question. By year 30, it will have cost you $261,000 because the time value of money continues to add to your transfer of wealth to somebody else. This is what that looks like. You've got your mortgage price of $247,000. You've got what it would cost to pay the house off in 15 years of $312,000. You've got what it would cost to pay for the house if you took the 30-year mortgage, $417,000. You end up saving $104,000, almost $105,000 if you go with the 15-year mortgage. But the growth that you could have earned on that difference is $143,000 by year 15, and $261,000 by year 30. It's a different way to look at it. But this is a transfer of wealth from you to the mortgage banks because they want you to pay your house off early. Now let's take a look at the cost of a mortgage interest. And what if you took that $583.21 and put it into a life insurance policy that allowed you to participate in dividends and was a whole life policy that would last your entire lifetime? And if you paid those extra money that you would have paid to your 15-year mortgage to the life insurance policy, you will first of all have a death benefit that will pay your mortgage off within the second year, possibly even sooner than that, okay? And you will have developed at least $115,000 of cash value, which is $10,000 more than what you saved by paying off your house in 15 years. And you could possibly have as much as $121,408 with dividends. at that same time. That's $16,000 more than what you would have saved by paying your house off in 15 years. But here's some more added benefits. Your premium is waived during any time of continued disability. So if you became disabled, you're not going to lose this policy. It's going to continue to grow just as if you paid your premiums, because the premium is waived because of your disability. A portion of your death benefit can be used if you have certain qualifying medical expenses for a critical, chronic, or terminal illness. You can pay up to 100% more into the paid up additions rider as a way to even keep more money if your cash flow allows it. Or if cash flow is tight, you can pay up to 50% less into that paid up additions rider for 5 continuing years without affecting how much you can continue to pay into that rider. You can choose whether this policy is going to have direct or non-direct recognition, which can be huge depending on what's happening in the economy at the time. And there are no premiums required after the 15th year, just like paying your house off in 15 years. And this policy will continue to grow after 15 years. Fact is, it will grow for the rest of your lifetime. All dividends that are declared will continue to be paid, which will increase your death benefit and your cash value availability. And your total death benefits, as we said earlier, will continue to rise because of that. And you will seriously dampen the effects of transferring your wealth to the mortgage bank. But the benefits continue. You've only paid $104,978 for this policy. But by year 18, you have enough money, cash value in this policy, that if you choose, you could withdraw that money or borrow it and pay your house off that you're paying for 30 years instead of the 15-year mortgage. And you would still then have a policy that was effective and providing a death benefit for you. By year 30, you will have recovered 96% of the list price of your mortgage by funding a life insurance policy and a 30-year mortgage instead of just going for the 15-year mortgage payoff. And by year 45, you will have $12,919,000 more than what you would have had you just paid your 15-year mortgage off. Plus, you'll still own your house. Living past age 85, the policy will continue to grow. No premiums required. Dividends will continue to make your death benefits go up. And the cash value will go up every year, guaranteed. The money can be spent on anything. There's no restrictions, no requirements, no penalties, no fees. All you have to do is pay the interest on a loan if you borrow it, or if you withdraw it, then you can withdraw up to the cost basis that you've put into this policy. And if you withdraw over that, you'll pay the income tax as if it was earned income. You won't have to refinance your house to get that money. No reverse mortgages required. And you'll have access to money that normally would have gone to the mortgage bank. And if you die, anything you haven't spent will be passed on tax-free to someone you love or to some organization that you care about. The cost of home mortgage interest is huge. Earning 4% annually on the $583 you save monthly on a 15-year mortgage compared to a 30-year mortgage would give you $143,000 in year 15. To produce as much growth as what your life insurance policy cash value growth by year 15 to between year 15 and year 30 would require that you experience a 3.35% rate of return annually on that $143,000. So let's back up and explain this a little bit. If you saved your $583 every month instead of paying off your 15-year mortgage, invested it and got a 4% return for those 15 years. And then from there on, you don't contribute anymore because you wouldn't have contributed anymore to the mortgage bank to pay your 15-year mortgage off. It would have been paid off. And so now what do you need to earn on that $143,000 from year 15 to year 30 to equal what the policy will have for you? And that number is 3.35%. From year 30 to year 45, you would have to earn 3.99% annually in order to keep up with the cash flow in the policy. And as you can see from our earlier slide projection of the S&P 500, that may not be possible. Another way to look at this is you've saved $104,977. That's the cost of the $583 per month for 15 years. To lose $237,000 by year 30 by paying off your mortgage in 15 years instead of 30. That's a huge transfer of wealth. That's 125.77% loss by year 30 compared to an insurance policy. This is what it looks like. You've got the cost of the mortgage, $247,000. You've got the cost of paying your house off in 15 years, the cost of it if you took the 30-year mortgage option. You've got the difference between the 15 and the 30-year mortgage payments of $121,000, and then you've got the growth in the policy of $237 or $430. You see, the cost of home mortgage interest is interesting. According to the U.S. Bureau of Labor and Statistics, prices for housing are 113% greater in 2019 than they were in 1989. In other words, housing that cost $500,000 in 1989 would cost over $1 million, about $1,068,000 in 2019 for the equivalence purchase. At that interest rate, you would only have to earn 1.4% annually to fare better than purchasing your house. According to Robert Shiller, the Nobel Prize winner in economics and the professor at Yale, says that historically, the actual rate of return on owning your home has been virtually zero. And that remains true today. I want to take a little break here and remind you that tomorrow at 1 o'clock, we'll be right back here with a question and answer session. And you can go right now, click on the bell, and register for that YouTube Live tomorrow at 1 o'clock. So if you want to attend tomorrow, make sure you click on the bell and just register right now, and we'll see you here tomorrow for a question and answer session. Paying cash for major appliances is another huge transfer of wealth that occurs in our society, something that you can control to a large degree. According to this website that tracks this kind of thing, Americans spend about $60 billion on major appliances every year. Refrigerators typically last 14 years, stoves and ovens around 17, washers approximately 13 years, dryers last on average 14 years. But the dishwashers don't seem to last that long. They last about 10 years. So let's take the 10-year average here and let's work with dishwashers. Now, there's different varying price ranges for dishwashers. You've got your contractor special, the basic one, between $249 and about $500. And then you got your mid-range from there to about $1,000, and then you got your luxury ones that are any from there on up to $2,000. So let's just take a basic contractor's model and say that you replace your dishwasher on average every 10 years of your life for the next 50 years if you're young, or maybe you've already replaced a few if you're older than that in your life. I know we have. Paying cash for a basic $400 dishwasher 5 times during your lifetime will end up costing you $2,000, not considering inflation. But paying cash for those dishwashers will transfer a huge percent of the wealth you could have earned if you could have earned 4% annually on that $2,000. Let's take a look. Paying cash transfers your wealth to others. Always does. There's always a cost to paying cash. You either give up the interest you could have earned by paying cash, or you lose the interest that you have to pay to someone else when you finance it. There's no other two ways to purchase anything. And so in this case, you lose 176% more than the actual cost of the dishwashers. Here's how it works. In column 1 here, we have dishwasher 1, 2, 3, 4, and 5. So we see that each of those cost you $400, and by the end, we have a total cost of $2,000. But that first dishwasher, what if you could have earned 4% on that $400 for 50 years? Well, you would have had $2,842. The second dishwasher, you could have earned 4% on that cost, that $400, for 40 years, and so on down to the last dishwasher, which you could have earned $400 for 10 years in our 50-year example here. By the time you're all done, that's $7,528, almost $29, that you have lost that could have been yours had you not had to replace your dishwasher so frequently. And as we said earlier, that's 176% more than the actual cost of your dishwasher. That's a huge transfer of wealth. Buying term and investing the difference just to save money is the final example that we want to look at today, because this is such a misnomer that it's ridiculous. It's like throwing the baby out with the bathwater. Now, there is a place for term insurance, believe me. We sell term insurance because it is the cheapest way to cover liabilities when you're young, healthy, and have dependents that are depending on your income. But it is not a way to keep the transfer of wealth from happening in your life. And we're going to look at that and examine that very closely, because it is important that you understand, as soon as it's comfortable and affordable for you to own participating whole life insurance, you should make that decision to do so. Consider a 40-year-old healthy male. And we're not talking about someone in their 20s. This would be a whole lot less expensive. We're talking about a 40-year-old average American healthy male right now. And the cheapest premiums that you can buy for a term life insurance policy, if we're just looking to try to save money on the annual premium, is a 10-year level term policy. You're going to pay $208 for that if you're a 40-year-old healthy male today. Now, when this healthy male turns 50, if he's going to keep that policy, which is renewable, he'll pay $2,470 the next year for it. And the year after that, it will go up. And the year after that, it will go up. And the year after that, and it will continue to go up for the rest of his life. And so he sees that, and his insurance agent and typical financial planner tell him, oh, start a new level term policy for 10 years. It's the cheapest way you can do it. That policy, if his health has stayed the same and he hasn't gained a lot of weight, will cost him $420 a year for the next 10 years. And at age 60, he realizes his house still isn't paid off, and his children's educational costs have not been recovered, and so his retirement plan is suffering. And he still wants to have coverage for his wife and his to replace that income that he hasn't been able to keep. And so he renews the term. He doesn't renew that term policy. He buys another term policy. And again, considering he hasn't gained weight and is still in good health, this one's going to cost him almost $1,000 a year, $912. But if he had kept the second policy, he'd be paying $5,100. So his agent says, oh, this is the cheapest way to go. And every typical financial planner would agree with that. But buying term life insurance to save money over time puts a lot of money into the insurance company's pocket. Purchasing term insurance is only necessary until you have the whole life insurance to cover your liabilities. Anything more than that is simply transferring wealth to the insurance company. Let's explain why. Let's look at those policies that our 40-year-old term life insurance purchaser bought. His first policy ended up costing him $2,080 out-of-pocket expense. His second policy, $4,200 out-of-pocket expense. Third policy, $920 out-of-pocket expense. Total cash value, nothing, zero, niche. Total cost for all this life insurance over these last 30 years, $15,400. His death benefit, now that he's age 70, zero. Absolutely nothing. Absolutely no equity was ever developed in that term product. What about whole life insurance? Well, if he had bought whole life insurance between years 1 and 10, he would have paid $69,985. Now that's a lot more than $2,080. Between year 11 and 20, he would have paid $34,993, which is a lot more than $4,200. But between year 21 to the end of his life, he pays zero. So the total cost of his insurance is still higher. It's $104,978, which is greater than the $15,400. But instead of having zero cash value, he now has $237,013 of cash value. So his total cost has been reduced to $132,000.35. The difference is his. He developed equity in this policy. And the reason that is because it's a participating policy, which means you are an owner of the company and participate in the profits of that company instead of just leasing a product from them from year to year to year. Buying term life insurance to save money is a great way to transfer wealth to an insurance company. Let's take a look at that. Term life insurance products have a less than 2% chance of ever paying a death benefit, and the insurance companies know that, and you should know that too when you buy it. It's not a permanent way to solve a liability issue. Buying term insurance to save money is a way to have coverage over a 30-year period of time, but it is literally transferring your wealth to the insurance company unless you die while the policy is in force. And if you want to take the risk on that 2% payout period, then that's fine, but just realize that the probability of you dying during the time that that policy is in force is very low. And so you should be very happy that the premiums are very low at the same time. However, this produces a huge profit for the insurance company, 1,046%. Let's watch how that works. If the insurance company can earn 4% on those premiums on that term policy that is renewed or replaced every 10 years for 30 years, let's look what happens to that money. Because the insurance company just doesn't throw that money away after 30 years. They keep reinvesting it and making money on it for 80, maybe 100, maybe even longer than that years. That money goes to them just like the money from your mortgage went to the mortgage bank, and they continue to use it and make a return on that. So let's take a look and see what happens. Here's your first policy, the term policy, $208 a year. Well, if you could have earned 4% on that, which we're assuming now the insurance company is going to be able to do because historically they have been able to do 4% very easily. That means the insurance company made $5,690.70 on that premium for you. In the second policy, your premium of $420 per year, the insurance company made $7,762 on that. And the third premium that you paid at $912 a year, the insurance company made over $11,387 on that. So over the course of this 80-year period that we're using, from the time this person was 40 until they're 120, the insurance company collected $15,400 of premium. They invested it and ended up making $176,537. This is one of the reasons, a very strong reason, why insurance companies are so stable in a market that is so volatile, because they're earning premium dollars that they know they will never have to pay death benefits on when they sell term insurance or when they sell any product that is based on a term product like a universal life product. The transfer of wealth is destroying the financial peace of mind of millions of Americans today, but you can change that. You don't have to be subject to all the things that we've talked about, and we've just talked about a few of the many areas where people are willingly signing up for the transfer of wealth from themselves to other people, whether it's the mortgage company, whether it's the credit card companies, whether it's the 401k managers or the IRS, whether it's the insurance companies, you name it. So let's really consider this. Use your credit cards and unsecured debt responsibly. It could save you 45% or more, and it will keep the transfer of your wealth from going to the credit card companies. Don't withdraw funds from your 401k or IRA without understanding the long-term cost of doing so. It could save you 166% or more and stop the transfer of your wealth from going to the IRS. Don't pay extra simply to pay off your mortgage early. If you rent something that is less than what you can afford and keep the difference. If you do so, you can save 125% or more, and you will stop transferring your wealth to the mortgage banks and the rental property owners. Purchase quality appliances and keep them maintained properly. It could save you over 176%, and it will stop you transferring your wealth to others. Only purchase the term insurance that you absolutely need and invest the difference in yourself by purchasing participating whole life insurance. If you can't save, you can save yourself an infinite percentage, and you will stop the transfer of your wealth to the insurance companies. The most important thing you can do is to start keeping your money where you are not penalized, locked out, taxed, or forced to take a loss when you want to use your own money. A 25-year-old who keeps that $583 per month that we talked about on the 15-year mortgage versus the 30-year mortgage and uses it to pay participating whole life insurance premiums instead of paying cash for major purchases, interest, extra 401k contributions, or extra mortgage premiums can build cash values that exceed $945,000 by the time they're 65 years old. With no other premiums after age 65, that fund will grow to be over $1.5 million by the time he's 75. 100% of this money can be easily accessed without taxes or being counted as income. If over his lifetime, this policy owner would have borrowed against his growing capital to finance the things that we all need to purchase in life and pay himself back what he would have had to pay others had he made those purchases by financing them or paying cash, he will stop the transfer of wealth to others in his life and will direct all that money and capital back to himself. And as you know and have now seen, this will increase his abilities to build wealth for himself that he can choose to transfer to whomever he wants to by saving up to 45, 170, 166, 125, 100, and even more. It all depends on how you want to manage your money and the cash values in your life insurance policy. It's up to you. These are things that you can control. Your financial peace of mind is something that only you can control. You can call our number, 702-660-7000, or you can go to lifebenefits.com, life-benefits.com, and you can schedule an appointment to discover the financial formula that we use to help you keep from transferring your wealth to others and have the financial peace of mind that you need in these times or in any other times. The appointment is free, but your commitment must be 100%. if you really and truly want to stop the transfer of your wealth to the IRS, credit card companies, mortgage banks, rental property owners, insurance companies, and others. This is up to you, your commitment. Your appointment is free, but it could save you tens, even hundreds of thousands of dollars. So schedule your appointment now.